to compete with the teams. Okay, welcome to the afternoon session of the 2022 CDAR Symposium. So it's my extreme pleasure to introduce Terry Odean, who is the Rudd Family Foundation Professor of Finance Group at the Haas Business School at UC Berkeley, an advisory editor to Financial Planning Review, a member of the Journal of Investment Consulting Editorial Advisory Board of the Russell Sage Behavioral Economics Roundtable, a Wall Street Journal panelist. In 2016, Terry received the James Verton Award from the CFA Institute for research notable for its relevance and enduring value to investment professionals. It goes on and on and on here. I'm going to let you read all of this yourself instead of my reading it to you. I just would like to add my own view. Terry is one of the most interesting, entertaining, insightful, and incisive researchers that I know. His talks are fantastic, and so glad you're here to listen. Today's topic is the influence of retail investor attention and demand on stock prices.
All right, thank you. Okay, so I'm going to be talking about a couple of different papers that are related to this topic of how retail investors behave, how it affects prices. It actually goes back to when I was a student here. I got my PhD at UC Berkeley, and as part of my dissertation, I wrote a paper that showed that the stocks that individual investors bought tended to go on to underperform the ones they sold. And even at the time, I was surprised. That's not what I expected to find. What I expected to find is the stocks they bought, the stocks they sold did just about as well as each other, but that they lost money because they were paying commissions and bid-ask spreads. But they were actually doing worse than that. I remember at the time thinking they must be doing something themselves that's creating the opportunity to lose money, but I wasn't quite sure what it is. And I think we're getting a little closer to understanding the whats and the whys. So first part here is about sort of a puzzle, which is that at short horizons, the order imbalance of retail investors positively predicts future returns. So if you look at what stocks retail investors buy versus sell, and you take the ratio, and one might, you can say, you can quite simply just sort on the percentage of their trades that are buys for each stock. And several people have looked at that. My colleague Brad Barber and I and Ning Zhu looked at it several years ago using a weekly horizon. We found that the stocks that retail investors were on the buy side for cross-sectionally did well for the next week and the next couple of weeks. And it was a pretty strong effect. And what we thought was going on was basically just a tendency, sort of a lag in the behavior of retail investors. That some of them would be buying it one week and some of them would probably be buying it the following week. And other people have confirmed this looking at shorter horizons and even sometimes longer horizons, that for one thing, what they buy, what retail investors are buying in one period, to a large extent, there's a positive serial correlation. They buy the same thing the next week. And institutional investors, when we looked at this, we found that their reaction time was faster. That you might say, okay, if a bunch of institutional investors buy something today, maybe there'll be a bunch buying it tomorrow, but the signal dropped off pretty quickly. So that's pretty well established. If you sort stocks based on the order imbalance on a particular day or week, and then look at subsequent performance, it's a positive signal. The other side of it is that retail investors, studies I've done and other people have done, the studies show that retail investors tend to lose money by trading. So the ostensible puzzle is, how is it that their trades positively predict returns, and yet they're losing money, and even losing money when you separate out commissions and spreads? So here's just a few quotes. Even when trading costs are ignored, these individuals actually lower their return through trading. On the other side, evidence consistent with informed or skillful trading, the paper by individual investors, or Burmer, Jones, Zhang, and Zhang say we attribute half the predictive power of retail order imbalance to informed trading. So the first part is just, how is it that you can get both of these results? And that's actually fairly simple. And I can give you the intuition with a simple example. So suppose we have an investor, and let's say 1 week he buys $1,000 of stock A, $1,000 of stock B, and $3,000 worth of stock C. Well, if and let's say A goes up 1%, B goes up 1%, and C goes down 1%. If you form a portfolio, if you formed a portfolio of his holdings but equally weighted the stocks, which is what Brad and I did and other people did. We also did capitalization weighting, but normally what people were doing when they were sorting on order and balance and then seeing what the subsequent return is, you'd say, okay, this guy's stocks positively predict the market. The stocks he's buying did well. On the other hand, if you take a look at his portfolio, the portfolio is losing money. So basically, that's the difference. That's why these two literatures come up with different results. Because one is, the performance ones are basically weighting portfolios by how much people buy, and the other studies tended to basically just look at which stocks had a positive order imbalance and then equally weight or capitalization weight those stocks going forward. So now the question is, why are they losing? How is it that the investors tend to end up with this result? And I think from this, you can figure out that what must be going on to some extent is that they are trading more, or basically buying more in volume in the stocks that go on to do badly. And that's what we started to look at to try to understand what's going on in this paper. So first, this is the result simply if you equal weight order and balance strategies. So these strategies are, you sort stocks into 5 quintiles based on the order and balance, the extent to which it can simply be the number of purchases divided by purchases plus sales. You sort into 5 quintiles, and then you see what happens over, in this case, I guess the next 5 days. So you've sorted, and then you look at what the stocks do going forward. And that's what we have here in the black line, and consistent with several other papers that have looked at this, we find a positive return. It's not an excitingly large return, but it's there. And the red line is, now we're basically doing the same sort, but instead of equally weighting the stocks in the portfolios, we're now weighting them by how much trading there was, how much the retail investors were trading them. And so this is basically a long-short portfolio. You're going long the stocks that the investors in the quintile they were buying the most, going short the ones that they were selling the most. When you equal weight, you make money, but when you weight by the purchase weight, you lose money. So digging a little bit deeper, we now sort stocks. We first sort into the 5 bins based on order imbalance, but then we sort again based on abnormal trading volume. So we sort stocks into deciles based on whether abnormal retail trading volume. So based on whether retail investors were trading a stock more actively than they usually do.
Does this say that stocks that trade more and worse than stocks that trade less?
It's a double sort. Basically, that is true. I mean, that by retail, but we're talking about retail investor trading, and we're talking about being on the buy side of the market. So stocks that trade very actively with retail investors on the buy side of the market tend to do poorly. That's sort of the upshot here. So here, oops, well, I don't know, maybe I won't stand there. The black line, the red line is the stocks in the high abnormal trading volume decile, and in the quintile, the buy side quintile, the 20% of stocks that retail investors were on the buy side of the market for. And you can see, I mean, there's basically nothing going on with the 90% of stocks without, that have more or less normal trading volume, but the ones with extremely high trading volume are doing poorly. When you look at the bottom quintile of order imbalance, those are the stocks that retail investors were on average selling, you can see that there's a little bit effect that the ones that with high abnormal trading volume go on to do well. Of course, that doesn't benefit the retail investors because they were on the sell side of the market for those stocks. And when you form a long short portfolio, you find that for 90% of stocks that have do not have extreme abnormal trading volume, the long short portfolio has a positive, not dramatic, but positive return over the next 5 days. But the stocks that the retail investors were trading most heavily go on to do badly. So if you're going long the ones they were buying and short the ones they were selling, and that portfolio performs badly. All right. One other aspect of this, sort of separate from the predictive point of view, but retail investors, not surprisingly, tend to lose money the day of the trade. There's a bid-ask spread. I'm not looking at commissions, but there's a spread. But what we find is interesting is if you look, here is sort of the normal volume, and here are the 10% with the high volume. We've sorted the stocks again into 5 quintiles based on the order imbalance. And you can see that their underperformance in most cases is actually less than the bid-ask spread. So that could be that they get a little price improvement, or it could be that there's just a very small signal. Yeah.
Do you have any information on where the trading actually happens? Is it on the exchange, or is it payment for order flow? Any idea where the trading is actually going on?
In this study, yes. So in this study, all of the trades that we're able to identify as retail, we're using the Bermer, Jones, Zhang, and Zhang methodology to identify retail trades and to sign them. And the methodology basically it essentially is only identifying stocks that were probably where there was payment for order flow, because it identifies stocks that are in the TAC data are on exchange D, which means they were off exchange. And I'm working on another paper right now to just see how good this methodology is and to suggest some improvements. But the trades we're looking at here, the earlier thing that I said about order imbalance that Brad and I, Ning wrote 2008. That was using TAC data when you could still identify retail trades using TAC data by trade size. That kind of ended in about 2000 or 2001. So these are retail trades, and they will almost all be at a discount brokerage with payment for order flow. Yes. What? We started about 2007, and I think we're running through 2019. I think I'm close, but what do you mean by the impact? I'm writing a paper right now that sort of looks at that. Yeah. Yes.
Are you able?
The interesting thing also that we find out is not all payment for order flow is equal. Yes, and it matters. The more payment for order flow your brokerage is collecting per share traded, the less you can less price improvement you can expect.
Are you able to differentiate limit orders from market orders? Maybe they get socked on market orders somehow.
This methodology right now is probably only going to pick up market and marketable limit orders. Okay, that the way that's pretty much was also true when we were using TAC data. So and you can look at Rule 606 disclosures for different brokerage firms to see what fraction of their trades are undirected market or marketable limit orders. For most of the discount brokerages, that will end up being the majority, but not everything.
It would be interesting to be able to compare the two, because you might be more sophisticated if you're doing limit orders.
It's possible that more sophisticated investors are placing limit orders. This is not part of our paper, but what I have read is that limit orders aren't always treated that favorably for retail investors where there's payment for order flow, that they get shunted off to venues where institutional investors pay to be able to come in and pick them. All right, so the interesting thing here is that for the most part, the retail investors are doing slightly better than the bid-ask spread. However, when they are on the buy side of the market and trading volume is high, they do really poorly on the day of the trade. The stocks continue to do poorly, but they do poorly on the day of the trade. All right, that's one paper. I want to talk a little bit about sort of the psychology or mechanism of what I think is going on. Brad and I wrote a paper, a different paper, also 2008, about attention. And we start off with that paper. The question we were asking is, how do individual investors pick the stocks they buy? And what we thought was, well, most of them aren't going home with a folder of all the information about the S&P 500 companies and going through those folders and saying, I think this is the one I like best, or the second best, or the third best. I mean, that's not the task anyone really wants to do, and certainly not what your casual investor is doing. And most of them are probably also not running a computer program that would be essentially doing that for them. What we thought was probably happening is that people wait for a stock to catch their attention, and then they ask themselves, do I like it or not? So preferences and beliefs might vary. For example, Greg and I might be two retail investors. Let's say this is, we're old school and we read the Wall Street Journal, and we open the Wall Street Journal and there you go. And there are 10 stocks mentioned on the front page because we're in a hurry. We never get to much past the front page. And we look at those stocks and let's say Greg is a Graham and Dodd style investor, and he looks at one and it's been out of favor for a while and has pretty sound fundamentals, and he says, that's the stock for me. But I'm a momentum investor. I believe that what goes up. So I look for a stock that's had positive earnings surprises for the last 3 quarters, and I buy that. So we buy different stocks, but attention has taken the choice set from 4,000 or 5,000 stocks down to 10. So what happens when the attention of 1 million investors is focused on a few stocks? Some of those stocks are going to appeal to a lot of those investors, and they will end up buying them. Not so much on the sell side. Some of them might decide to sell, but retail investors very rarely, not never, but rarely sell short. And they tend to, in the data sets I've looked at, they've tended to own 4 stocks. So if your attention is drawn to a stock and you already own it, maybe you'll sell it. But really, I think selling doesn't have that search. The search problem isn't so much of an issue, because if you only own 4 stocks, you can just say, if you need to sell something, you say, do I want to sell A, B, C, or D? The rational investor can sell a loser and get the tax write-off, and most investors will sell winners because they don't like to sell losers. That's just how it is. That's your disposition effect. So we think attention affects buying, and it doesn't affect so much for institutions. We're not saying not at all, but less so. And that's quite simply, institutional investors have more attention. They have all day. They're professionals. They use computers. They work in teams. Plus, they tend to own larger portfolios. If you own a larger portfolio, then the choice set, there's not as much asymmetry between what you can buy and what you can sell. And some of them do sell short, in which case, the universes are the same. So in this paper, what we showed, we used different proxies for attention, and we showed that as the attention of retail investors towards a stock went up, the investors were more and more and more on the buy side of the market. So the upshot is trading volume goes up, but it tends to go up on the buy side. For the retail investors, price depends. It depends a lot on how large the stock is, how much the effect of retail investors buying is going to be on price. But when the capitalization is low and the average trading volume is low, price will get driven up, and then price subsequently decreases, though it does not usually go back to where it started. I'll talk about that a little bit at the end, at least why I think it doesn't. All right, anecdotes. First anecdote. SIGL, Signal Advanced. Here's the volume, which is the blue bars, and the price for late December until mid-February 2020. Late December, oops, I'm sorry. That would be this should have been 2021, from late December 2020 to February 2021. All right, as you can see, a lot goes on here. The red line is the price. The price goes from around 60 cents and shoots up, hits $70, and then closes. So it's about 60 cents on a Thursday morning, shoots up by Monday. It peaks Monday at about $70, closes at 38, and then comes back down. What went on? Jonathan mentioned Mr. Musk. Mr. Musk sent out a tweet, 2 words, use Signal. At 4:56 a.m., when other people would be sleeping, he was tweeting. All right, so he sent out, a tweet to use Signal, and people paid attention. The Signal stock went from about 60 cents to about $3.60 or 80 cents the day the signal went out. Then it went up to about $10 the next day, and then it peaked at 78 the following day. Volume went through the roof. In fact, there were 2,000 shares traded. 2,000 shares were traded at the beginning of this period. The number of shares being traded went up over 2 million on that Monday. So apparently what Mr. Musk tweets catches the attention of a lot of investors. But you can see when it settles down, the price is still 5 times as high as it was at the beginning of the period, and the trading volume is 100 times as high. So, and then the other thing probably worth mentioning is Mr. Musk was not tweeting about this company. He was tweeting about an app called Signal. He was not tweeting about Signal Advanced. And that was revealed. There were both the app company and Signal Advanced made public statements before the weekend that this was a mix-up. And the people at Signal Advanced were saying, you know, you should apply due diligence and stuff. Nevertheless, the price went from $10 to $70 the next after the weekend. So it continued to skyrocket even after there was plenty of public information about the mistake. Okay, one other example that's a little, at least this was not a case of mistaken identity. Entramed, this is from, this graph is from a paper by Huberman and Regev. Entramed was a company that was a biotech company involved in research, trying to develop a cure for some types of cancer. There was a Nature article published in November of 1997 describing the research they were doing and mentioning that Entramed owned at least some of the rights to this technology. And the day actually, the day after the Nature article, the New York Times had a back page article that talked about this as well. On May 3rd, which was a Sunday, there was a front page article in the New York Times with the same information that had been in the Nature article, talking about Entramed, talking about the new technology. What happens on Monday? The stock price shoots right up, and then it falls and gravitates. It comes down quite a bit from its high. So what's new here was just that the information was already public. It's just most retail investors don't read Nature. But apparently a bunch of them were looking at the front page of the New York Times. And it made a huge difference. Now, this is from their paper. We went back and took a look at what retail investors and institutional investors were doing in Entramed during this period. So what this is, the number of purchases, the cumulative number of purchases minus number of sales by retail investors, small trades going back. And you can see there was the tiniest little blip when the Nature article came out. There was a little bit more buying activity that day. When the New York Times article came out on a Sunday, on Monday, retail investors were way on the buy side of the market. And they continued to be on the buy side of the market for about a week. And then there was basically no net buying or selling. They just stayed there as the stock price dropped off. Meanwhile, institutional investors, they were pretty flat coming into this, and they were net sellers after the price spiked. Right? They look at something and say that price just went from $12 to $48. Might be time to sell. So they were, they're on the other side of the market. A couple of other examples, and these are from, basically first looking at other people's papers. There are a couple people here old enough to remember the dartboard game, right? in the Wall Street Journal? Certainly, certainly there's a few. So the Wall Street Journal used to have an occasional column where there would be 4 money managers or analysts who were asked to recommend one stock that would then go into the portfolio of 4 stocks for the next, I forget, 3 or 4 months. And then the editors presumably threw darts at a wall where the names of the various companies were, and they picked 4 stocks randomly. And, you know, some months later, you'd find out whether the experts or the darts had done better. And on average, the experts outperformed the darts, but not always. So it was a bit amusing. The column came with a nice little etching, you know, drawing of the face of a portrait of the person making the recommendation. It came with a rationale for why we think this is a buy. One thing you can probably figure is that this money manager had already bought whatever he or she was recommending, or the analyst had already made the recommendation. So there was not reasonably any news there, but it was the sort of attractive, attention-attracting event. Here's from Knopfsinger, shows, you know, the price would go up and it would drift down over the next several days, many days. What we went back and looked at was basically what retail investors were doing across these events and what institutional investors were doing. And it's not too surprising. Retail investors heavily bought. They were on the buy side of the market for the next couple of days after a stock was mentioned in the dartboard column, and institutional investors largely just ignored it. There was no news there. By the way, I don't have the slide here, but we find that the retail investors did not react to the stocks that the darts picked. So there's some good news. Cramer, you know, before Wall Street Bets and Reddit grabbed every retail investor's attention, Cramer used to get quite a bit of attention, and he was, you know, very dramatic. And a paper by Engelbert, Sassville, and Williams showed that indeed, when Cramer recommended a stock, the stock price would go up, and then it would drift down later. And the downward drift was less pronounced for less liquid stocks. We took a look at what retail investors were doing, and, you know, no great surprise, retail investors were buying right after Cramer recommended something. Robinhood, how am I doing? Yeah, it's Robinhood. So I wrote a paper about Robinhood last year with a few co-authors, and I opened up a Robinhood account because I thought you should have some, you know something about the thing you're writing about. I was really impressed. The app does what it's intended to do. Now, which is it makes it very easy to trade and does not create frictions, either mechanical frictions or difficulty of execution or psychological frictions when trading. So I opened up an account, I transferred $500 into the account. I figured that in about 3 or 4 days, when the bank transfer cleared, I'd be able to place a trade. Much to my surprise, I was told I could place a trade immediately. So I did. I placed a trade, and I believe the confetti is now gone, but there was still visual confetti. You know, my screen was filled with confetti and congratulations when I placed my first trade. I was excited. And pardon? Yeah, I know what's been doing. Yeah. But it made it very easy. The app website is very simple. It does not have a lot of information, and that's quite possibly because a lack of information makes it less intimidating than if you were looking at a lot of like PE ratios and data and then started to think, I don't really understand this, maybe I shouldn't be trading. It's very easy to trade, and it's been extremely popular. So what we did is we used data from RobinTrack, which now has been ended because Robinhood's API, it doesn't make the data available, but it's fairly coarse. What we look at is changes in the number of Robinhood users. But we think that's still a pretty good measure. This is graphing Robinhood user changes and net TAC retail trades. And you can see it's not a perfect match, but it's tracking pretty well. So we think that looking at Robinhood, it's not I would never say that this is going to be representative of all retail investors. It's a certain type of investor that decides to go to Robinhood, but it's still indicative of the type of activity that what retail investors are doing. Here are two, again, basically just examples of one, anecdotes. One is Hertz, and these are examples of situations in which in one day the number of Robinhood users went up dramatically. And in this paper, that's what we look at. We basically look at, essentially, our main focus is the 5% of stock days in which the number of Robinhood users increases the most. This is a single example. The red line shows, or the green line, there's no red line. The green line shows you what happened to Hertz's price, and the blue line is what happens to the number of Robinhood users. And one thing that you can see here, and that you also saw in the Entramed example, is the number of users goes up as the price goes up, and that's probably a feedback loop. So they're buying because it's going up, and because they're buying, it's going up. So I can't, I wouldn't try to separate those. But one thing that we find is interesting and tends to be true is they continue to hold as the price goes down. And I believe that is the main reason that, especially for less liquid stocks, the price doesn't go down back to its starting point. Another example is Kodak. Here you see some selling, but there are far more people. Most of the people who bought on the rise are still owning as time goes on. And this is looking over, I forget just how many are in this sample. I think it's over 1,000 cases where you can see that the general pattern is a big increase in price. It drifts down, but generally nowhere near back to where it began. And even on average, the Robinhood user base increases after the event. Not dramatically, it shoots up with the event and then tends to increase. This is looking at basically post-herding returns sorted by herding intensity. So the horizontal axis is the user change, whether the number of users doubled, tripled, quadrupled. So here is, this is the cutoff for when the number of Robinhood users doubled in one day. And here's this is basically the post-event returns, that the price tends to drop off. The more, the greater the intensity of the buying activity, the more it tends to drop off, but also the more it probably went up. Well, I wasn't going to put any tables in, then I thought this is a sophisticated crowd. I gave a talk, a lot of this talk a couple weeks ago, left all the tables off, but this is just looking at some of the factors that seem to at least correlate with these herding events. And none of them are particularly surprising. If there was a big price move the day before, that's predictive of this. If the previous day's trading volume was abnormally high, oh, I changed this but I'm back on my old slides. This is basically user change. This is popularity change. It's just the change in the number of users and the absolute number of users there were on day T-1. We take a look at abnormal Google search volume for a particular stock. That's also predictive. We look at abnormal news coverage using Thomson Reuters Refinitiv database. That's also a positive predictor. And then earnings announcements. Really no surprises. It's basically largely measures of attention or likely measures of attention. Even previous days' extreme price moves are likely to grab investors' attention. Yep, that's a low R squared. So don't get too excited. No. I suppose we could take a look at things like how many times a stock is mentioned on Wall Street bets and stuff like that. I mean, it's really just a question of and the other one that we don't have in there, I don't think, is the typical amount of trading in a stock. So the retail investors, in the long run, they might push Apple or Tesla up, but you're not going to see as much like a big surge in one day. But so it tends to be smaller cap stocks that are more affected by this. Here's a back of the envelope calculation where essentially we estimate, and it's a pretty rough estimate that one of my co-authors did, but we estimate that the Robinhood users are losing money around these herding events. And so you say, well, the price went up, why are they losing money? It turns out most of the buying activity takes place after the price has come very close to its peak. It's like there was a great party, and it was an excellent party to be one of the first people to show up at, but these people are showing up at the end of the party. So another thing I wanted to mention is that we're looking at trading in equities, and for companies like Robinhood, very likely most of the action is in options in terms of affecting market prices. The payment for order flow for options, it's a little bit higher per share than for equities, but it's dramatically higher. What Robinhood has been getting in terms of payment for order flow is dramatically higher on options. So there's really a lot of retail trading taking place in options with the potential to move prices around in a short term. Former colleague of mine, Jim Angel, was a PhD student at Haas with me. He graduated a few years earlier. He's got a paper where he basically looks at this and does some estimates, but he estimates that for every dollar a retail investor spends on an at-the-money 1-month call option, an option market maker will buy about $10 worth of the stock to hedge. So there's leverage in terms of the dollars spent by the retail investors, how much price pressure that's likely to create in a stock. So why don't prices drop back to pre-herding levels? We do not answer that in any of our in our papers. But what I think is going on is that the people who owned the stock before the big price move, before the herding event, the price spike, who were interested in selling, many of them probably sold as it was going up a bunch. As everyone here knows, there are at least a class of funds, index funds, that aren't going to be selling anyhow, even if it goes up. And there are some institutional investors who probably won't sell immediately, even if they think that the stock price is overvalued.
Can I ask about the second point? So, does this mean that retail investors are a significant portion of all investors in this case who are trading in these specific stocks?
I don't know. I think it's probably, no, it's not the majority.
Okay.
But it's the stocks where they do represent more of the trading that are more price sensitive to what they do.
Okay.
And then the question is, again, what are the people potentially on the other side interested in doing? Index funds won't sell. A lot of institutional funds probably do sell when they see the price go up. And you saw that in the Entramed example. Institutions were selling as the retail investors were buying. But I think that what happens is that the people, institutional or retail, who are interested in selling because the price has gone up, get out as the price is going up. And then you're in a situation where the price is too high relative to any reasonable fundamental, but what's going to drive it down? The people who just bought at the top, retail investors who just bought at a high price, are not in the mood to sell a week later for a big loss. There's a lot of evidence on disposition effect. People really don't like to sell for a loss, so they hold on. They tell themselves stories or tell each other stories as to why it's going to come back. And even if they think it's not coming back, they don't want to nail down that loss. So these people aren't selling. Now you might say, well, it's simple enough. Some hedge fund should just come in and short the hell out of this stock, drive it back down to fundamentals. Sometimes yes, sometimes no. We all know about GameStop. A couple of months ago when I made this slide, GameStop's market cap was $9 billion. The short interest was $2 billion. That seems like an effort, at least, to drive the price back down. The price was $119, and I believe before all of the excitement, it started off around $10. So it can turn out to be basically just too risky for a lot of hedge funds, just in terms of not only the fact that it might move against you if the retail investors keep buying, but just the time frame for a bet that sooner or later probably will paying off just might be too long. You just don't want to carry a big short position for months and months and months while you're waiting for the retail investors to come to their senses and go somewhere else. I think it's okay. I've got one more slide here, but this was, yeah.
Is there data on the behavior of the institutional, these hedge funds, and whether you can map the short squeeze effect? Because that's one of the problems. Because you're carrying the short, and as the price keeps going up, you're asked to put more margin against that trade.
Yeah, I know.
And then you get this curse.
I know that there have been, I think, a couple of academic papers quickly written just about this example, and the GameStop, and that was so one thing that's changed. I don't think human psychology has changed dramatically since at least in my lifetime, but technology has obviously changed dramatically, and the technology of attention has changed. So people used to talk about herding, and people would say, okay, if everyone's buying the stock at the same time, we'll call that herding. If you go to actual herds and you're thinking about the buffalo, it's the buffalo following the other buffalo, and they see what the other buffalo are doing. Up until recently, retail investors didn't see what other retail investors were doing. their attention was perhaps attracted to the same events, Mr. Musk's tweet, for example, and their attention was attracted to seeing that the stock price went up and was reported in the paper as having gone up a lot. But there was very little direct way to know what other investors were doing. And Reddit and other social media have now changed that. So it's now possible for retail investors to tell each other what they're doing. Jonathan.
So the results are intriguing in the sense that aren't they more consistent with an information story? In other words, let's leave aside the fact that retail investors are getting their information late, right? But if you assume that they got the information about the stock and then said, oh, well, now we have a valuation that the stock is worth more, that's consistent with the story. They all buy at the high price. They don't buy at the low price. They're still willing to buy at the high price. And also consistent with the story that the stock doesn't go back to the old level. In other words, the massive investors who hold the stock after the event believe
Yes.
that the stock is worth more. But isn't that an information story, not a price pressure story?
Well, you can definitely tell an information story, okay? And really, it would be a long-run cross-sectional study that could tease those out. So obviously, any one example could go either way. But the question would be, will the performance of this stock in terms of future earnings growth, anything that eventually comes back to the pocket of the investor, will that be warranted in hindsight, if you look back, and then, right, because otherwise what happens is you end up owning something. It may not go down in terms of people driving the price down, but it'll just be disappointing. My guess is GameStop.
That's different, which is maybe the information's wrong. They're looking at the wrong information sources. Agreed. They're retail investors. But the alternative story that most people tell, I think, is it's not an information story. It's buying pressure. Right? There's no information.
The buying pressure drives the price up.
But what I'm saying is the evidence isn't that, because if buying pressure drove the price up, then the average guard would be buying on the way up. We wouldn't all be buying at the top. And then when the buying pressure is removed, it would go back to the old price.
I don't think so, because you have to look at both sides of the pressure. When that stock price goes up in one day and gets 20% higher than it was at the beginning of the day, that attracts institutional and perhaps some retail selling pressure. Now you've got a balance of the buying and selling pressure. And so the price, even though a lot of that retail buying takes place at the top, that's very likely where there's a lot of institutional selling. People who are saying, well, this might be a very nice time to unload this thing, especially if it's Signal and you're one of the people that's figured out that Elon wasn't even talking about this company. I don't know, Jonathan. This is that page that I had, that's speculation. As I said to begin with, I don't have a paper to back this up at this point. It's what I think is happening. And I'm often wrong.
Well, but I do think that the fact does seem to suggest that people believe, the new owners of the stock believe that the price is higher. Independent of whether those beliefs are right or wrong, that's not buying pressure. That is
but buying. I'm not talking. I'm saying after the fact, when the price sells, why doesn't it come down more? It's because they don't sell. As you say, maybe they don't sell because they believe that it's worth what they paid for it. I'm suggesting they hate to sell for loss. But when you don't sell for loss, you say to yourself, I'm holding on to this stock that is no longer worth what I paid for it because I'm the sort of person who just can't admit he made a mistake? Or do you say to yourself, I'm sure it's going to be okay?
Know who the owners are, or what percentage of it?
I mean, you know, the one example I gave, the Entramed, we were able to sort of see what was retail versus institutional investor. Yeah, I don't have a, currently we can use this BJZZ methodology to identify retail trades. I think it is a mistake to simply assume that the, you know, that the complement to that is institutional trades. I mean, the complement to that is a lot of stuff, including retail trades we can't identify. So I don't currently have a good source. You know, I wish we had better data. Greg.
I'm still trying to reconcile this with what you did in the very first slide, which had to do with the signal that the buyers, that voice traders give to investors on the very beginning. Is it possible that the size of the trade gets bigger as the bubble gets bigger? Look at
well, the number of trades get bigger. I don't know whether we could look at this. I doubt that the size of the individual trades changes dramatically. It could. I think what happens is you just see more of them. And especially on Robinhood, the trades aren't very large, but as I was saying, so it's quite possible that the options trades are creating, you know, even though there's not a lot of money behind it, it's leveraged 10 to 1. This slide basically doesn't, this was a slide from 6 months ago that I used in a presentation to the students. And my main point was all the things we've been talking about, and as Jonathan also pointed out, they are all ultimately tethered to fundamentals. That might be a loose tether, but sooner or later, someone's going to say, I'm tired of owning this stock that never pays dividends or never has positive earnings. There are some things out there that there is no constraint. It's whatever, you know, the people who are willing to buy and sell want to buy and sell it. So finally, the upshot is investor, when stocks have grabbed the attention of investors, individual investors, volume goes up. The retail volume tends to be on the buy side of the market. It drives prices up, and often the pattern tends to be, as best we can see, that the prices subsequently drop back, but don't usually quickly drop all the way back. You know, it could be there was a value in the signal that got over valued, but sometimes, like in the case of signal, there was no signal, and yet a month later the price is still 10 times what it was pre-event. Thank you.
We have another break.
Okay,
And
great.
see you back here in about 20 minutes.